Welcome back to Golden Forex YouTube channel. I am very excited to bring you another video, but before we get into today's video, make sure to subscribe and ring that notifications bell to stay updated with our latest video. In the previous video, we discussed the tools we're going to be using on this channel for our forecast and technical analysis. If you haven't watched that, the link is in the description down below. Now in today's video, we will go into the chart and find or identify the mitigation blocks. But before we start, here is a quick recap of the mitigation block. In this example, we're going to start with the bullish scenario of the mitigation block. Let's just say that for some reason we have done our analysis and have come up with the conviction that the market will likely create a low here and from there start to rally or move higher. And as we can see, the market indeed starts to rally and create a short-term high and starts to retrace back to the low it created. The market then fails to take out that low and starts to rally again, from which it takes out the short-term high and shifts market structure bullish. Once that happens, our focus and attention will be narrowed to this high right here, and inside that high is where we will find our bullish mitigation block, which could be a series of bullish candles or a single up-close candle. So, in other words, the bearish order block here becomes the bullish mitigation block once price shifts market structure to bullish at this short-term high. The closing price to the midpoint or the mean threshold of the mitigation block are considered to be highly sensitive. Again, the inverse is true for the bearish mitigation block. Let's just say that for some reason we have done our analysis and have come up with the conviction that the market will likely create a high here, and from there start to decline or move lower. And as we can see, the market indeed starts to decline and create a short-term low and starts to retrace back to the high it created. The market fails to take out that high and starts to decline again, from which it takes out the short-term low and shifts market structure bearish. Once that happens, our focus and attention will be narrowed to this low right here, and inside that low is where we will find our bearish mitigation block, which could be a series of bearish candles or a single down-close candle. So, in other words, the bullish order block here becomes the bearish mitigation block once price shifts market structure to bearish at this short-term low. The closing price to the midpoint or the mean threshold of the mitigation block are considered to be highly sensitive.
Welcome back, guys. We are now going to go into the chart and take a look at a few examples of the mitigation block. And from the previous video, we have at least an idea or a graph depiction of what the mitigation block looks like. So without further ado, let's get into it. So here we are on a price chart. And as we can see, this is a swing low followed with a rally and a swing high created right here. Then a retracement, creating a swing low, failing to go below this low, making it a failure swing. So now we have a low, a high, and a higher low. So once price trades above this short-term high, there is a shift in market structure. And as soon as that happens, the mitigation block is now been validated or becomes valid. Now, with the mitigation block, the most vital points of the mitigation block, in this case bullish, is from the bullish mitigation block high, the mean threshold of the mitigation block, and the low of the mitigation block. Now, the upper half of the mitigation block is considered the most sensitive. So from the mean threshold to the high of the bullish mitigation block is where you're going to potentially stalk your setup. So we can call this the bullish mitigation block high. We can call the midpoint the bullish mitigation block mean threshold. And as it was said in the PD rates video, it is always better if price doesn't close beyond the mean threshold of the mitigation block. Now, if you look closely, you will see that at the midpoint of the mitigation block, there is another PD array which can be paired with the mitigation block. And we talk about that PD array in the previous video, so you can check that out in the link down below. So that PD array is the fair value gap. As we can see, this candle's high and this candle's low does not intersect with one another, which leaves a gap right here called the fair value gap, or for short, FVG. So, as we can see, once price validated the mitigation block at this short-term high, we traded back inside the mitigation block to the mean threshold of the mitigation block, paired with another PD array, which is the fair value gap. And as it is seen in this example, the reaction of the mitigation block mean threshold and the fair value gap, we can see a beautiful rally away from the mitigation block. So let's go over the blueprint as to how to identify the mitigation block. So first we need a low, and I'm talking about a bullish example. So first we need a low, we need a high, and then we need another low which is higher than the previous low. So low, high, higher low, and then we wait at the high to be broken. Once that happens, it validates the mitigation block to be used. Now let's take a look at another example. So following the previous example, we have a low, a high, and a higher low, failing to go below this low, making it a failure swing. So we then wait for this high to be taken out, causing a shifting market structure. And as soon as that happens, it confirms our mitigation block. And as we can see, this is an example of a series of bullish candles. And you might be asking why we use just these two bullish candles and not all of the bullish candles. So for mitigation blocks, we use up to, or in this case, down to the failure swing after the shift in market structure. So from the shift in market structure to the failure swing, which is where the retracement ends, is the range in which we're going to be using for our mitigation block. So in this example, we can see from the third candle down, it all went below where the retracement ends. So keep that in mind. With mitigation blocks, we don't pick candles which go beyond this low right here. And we can see that candle number 1 and candle number 2 are the only candles that is inside the range of the retracement right here. So with that said, let's continue. And with order block theory, it is always better if price fails to go beyond the midpoint or the mean threshold of the mitigation block. And in this example, we also have an additional PD array paired with the mitigation block as well, which is the fair value gap. So to the extent to which price will go before reversing after entering into the mitigation block is by pairing it with another PD array. And the fair value gap is a very good pair for the mitigation block. And it is always better if price stays at or above the midpoint or mean threshold of the mitigation block. So as we can see, we shifted, confirming the mitigation block. Price returned back inside it for the first time, touching or going a little bit below the discount low of the fair value gap, rallied, came back once more, tapping the fair value gap premium high as well again, rallied a little bit as well, and then came back down, ultimately to close in all of this gap, which is a buy side imbalance, sell side inefficiency. So as it was doing that, it was very close to the mean threshold of the mitigation block. And as we said and stressed over it many times, it is always better if price stays in the upper half of the mitigation block. So that will be it for this video. And I intentionally left the bearish side of the mitigation block so that you could go into your own charts and then study the mitigation block with a bearish example. So up next, we're going to be talking about the breaker. So stay tuned for scenes from our next episode. So we're one more video away to the good stuff. So up next, we're going to be talking about the breaker. And after that, we will be done with the Genesis playlist, which will include all the PD arrays that we're going to be using when we start our forecast. So the wait is almost over, and we have just the breaker video left to be done with the PD arrays video. And after that, we're going to start our weekly and daily forecast. So if you are not a member of this YouTube channel, I would like for you to subscribe and turn on the notifications bell to stay updated.